Hello options traders, welcome everybody. And in continuation with our theme on technical analysis and technical indicators, I wanted to post another video here on another powerful, very common indicator called Relative Strength Index, or RSI. Now RSI, as you're going to find out, is quite simply a ratio between how many dollars came into the stock, how many gains did we have over a certain period, compared to how many losses. So as the name implies, it's just trying to show you, give you an indication of the relative strength of the up days versus the down days. So let's take a closer look at relative strength. Well, this indicator was developed by J. Wells Wilder in the late 70s. Like many of the other indicators that we've talked about with MACD and stochastics and Williams percent R, is an oscillator, but it's a momentum oscillator that measures the speed and change of price movement, so it's a little different in that respect. However, it does share in common that it uses, as its typical default, a 14-period range. Keep in mind, by using the word period, what I mean there is that it's just the time frame. If you're looking at a 1-minute chart, it would be the last 14 minutes. If it's a day chart, it's the last 14 days, week chart, last 14 weeks, and so on. That is the default, but of course we can change it. The formula, like a lot of the technical indicator formulas, looks a lot more intimidating than it really is. I'm going to break it down for you and show you how simple it is. But this is the RSI formula. So this is kind of the big complicated formula that it all boils down to when you're looking at your RSI number. However, in order to get this number, notice that we have this other calculation down here. We need something else called RS, which is relative strength. That requires another formula. So to find RS, it is simply the average gain divided by the average loss over a given time period. And like many of the other indicators we've talked about recently, RSI is a bounded indicator. And that simply means that the numbers that it produces have to fall within a certain range. And like all the other ones that we've talked about, at least that were bounded, it must fall between 0 and 100. Now, Williams percent R was a little different because it was between 0 and negative 100, but remember that's just on an inverted scale. But most of your bounded indicators are scaled so that they will fall between 0 and 100. And they do that so that we can find a relative high and a relative low. Now, another little difference here with RSI is that the default for these ranges is usually 30 and 70. Those are usually used to denote the oversold and overbought levels. Recall that in some of the others, especially with Williams percent R and stochastics, that they were 80 and 20. So this is a little bit tighter range. Of course, we can change it if we want, but as I mentioned in some of the previous videos, I would usually keep the defaults because that's what most people are looking at. And remember that technical analysis primarily works because it is a crowd mentality. It's just what everybody thinks is going to happen at a certain time. So when you're looking at technical indicators, you want to be sure you're looking at what most of the other traders are following. So for the most part, I would stick with the 30-70 bounds for RSI. Now, unfortunately, there is no real easy way to visualize RSI like I've done in some of the previous videos. You really just have to dig in and do the calculation. So I created a spreadsheet here to show you how it works. I'm going to stick with Apple because that's what I used in some of the previous videos, but I've dug up a lot more data. I'm going back about 3 months just so we could produce these charts over here. But here's the way it works. We've got a column of dates, and we only need to look at closing prices. Remember that with some of the others, such as like with stochastics, we needed a intraday high, intraday low over these periods. We don't need that for relative strength. We just need the closing prices. So here are all the closing prices. And then what we do is we're going to look at a 14-day period. So that's just this first 15 rows here. Now the reason we need 15 rows of data is because we need 2 just to produce the first value. I've got to have a starting point. So here you can see the stock closed at 167.78. And the next day it closed at 166.68. That is a drop of $1.10, and that's what we're showing right here in this cell. That's the change. We do the same thing. It went from 166.68 to 168.39 the following day. That was a gain of $1.71. The next day it went to 171.61. That was a gain of $3.22, and so on. We just keep working these net changes all the way through. To find RSI, we need to calculate the gains separately and the losses. So what we'll do here is this first data point that we got was a loss of $1.10. So obviously on that date we had no gains, but we had a loss of $1.10. Notice that I have taken away the minus sign because we're going to need to take the average. We don't want a negative number, so it's just saying the loss is $1.10. Next day we had a gain of $1.71, so we had a gain of $1.71 and obviously no losses. Next day was a gain of $3.22. It's a gain of $3.22 and no losses, and so on. So we only get one number reported in either the gain or the loss column, and the other will just be 0. Once I have 14 days worth of data, it's this column right here, we're going to do our first calculation. And over here what we're looking at is the average gain. So I'm just saying take this column right here, add up all those numbers and divide by 14. And if you do that, you're going to get $1.20. I'm going to do exactly the same calculation for the losses. Add up those 14 numbers, divide by 14, we get 84 cents. So what it's telling us up front so far is that of these 14 days, we had $1.20 coming in and we had 84 cents going out on average. So the RS figure, remember in the calculation I said there were two. There was RSI and then there was RS. RS was very simply the average gain divided by the average loss. So if we take $1.20 divided by 84, we get $1.43. If we take RS, this $1.43 number right here, and we run it through that big calculation that I showed you previously, that RSI calculation, we get 58.79. Now here's something interesting. If we were to graph all of these numbers right here, the RS calculations, we would get this graph right here in red. If I did the same thing for the RSI calculations, we get the graph in blue. And notice that they are identical. The one in blue is a little bit smoother, and I'll explain why in just a moment, but they're virtually the same graph. And that's why I said, if just conceptually, if you think of RSI as very simply the average gain divided by the average loss, that's really what you're looking at. Once again, the reason that we go through the bigger calculation to get the RSI number is so that we keep it between 0 and 100. But as far as the shape, it's going to look exactly the same. Now let me show you a little simpler way of conceptualizing RSI. I think that formula that they use, even though it is correct, is a little more complicated than it needs to be. If you understand odds ratios, it's much simpler. That's all you're looking at. So let's find an easy one down here. This row right here. We had $1 worth of gains. We had roughly the same number of losses. So think about this. If we just pretend that that was $1, you had $1 coming in out of $2 total. So that should be roughly an RSI of 50, and it is. And in fact, if I cheat here and make this $1, you'll see that it would come up to exactly, that's just from rounding errors, would come up to exactly 50. So if you think of this first data point here as $1.20 divided by $1.20 plus 84 cents, or roughly $1.20 divided by 2, you get 58. So to conceptualize it a little bit easier, what if we did this? What if we made it $3 coming in and $1 going out? RSI says it would be 75. Well, think about it. If 3 of the $4 in total were due to gains, then 75% were due to gains. And if we run it through the formula, you'll see why it works. If we have $3 coming in and $1 going out, the ratio is 3. 3 divided by 1. So RS would be 3. If I add 1 to that, it's 4. Divide that into 100, we get 25. Then we have to subtract it from 100 to get 75. In other words, 3 out of 4 is 75%. So it's just much easier if you look at it as what were the total number of gains divided how many dollars are we talking about. So I'm going to go back and change these now to their original numbers. Now the second thing you have to understand about RSI, and this is what causes this little bit of a smoothing effect here. We don't actually use this same formula for all of the later calculations. Instead, for this next data point, I'm going to take the previous number that I had up here times 13. In other words, I'm going to assume, because that was my average, that the previous 13 days were all $1.20. Even though that's not true, that's the assumption. And then I'm going to add the newest gain, which in this case was 0. And when I do that and divide by 14, I get $1.11. I will do the same thing here. I'm going to say that 13 times this value, in other words, the previous 13 days on average had a loss of 84 cents, plus this loss right here. And then we're going to divide by 14, and then we get $1.29. From there on, it's going to be exactly the same. So once again, because we use that what's called a smoothing function in there, it makes this blue line a little bit smoother than the red, but you can see that the overall shape is identical. So if we come down here to the bottom, if we did this correctly, today is actually June 29th. Don't have the closing data yet, so we have to just use the 28th. And you can see that RSI by my spreadsheet here is about 47.5, right there, 47.44. So let's go over to the E-Trade platform and see how it measures up. Here we are back in the E-Trade platform. By now, most of you know how to put your studies on, and you're going to choose from your list. Now, by the way, there's also a menu here that says All Studies. You can see there's a ton of them in here. So if you're not seeing it up front, you might need to dig through this menu. But right here is relative strength. And now, interestingly, they do an 80-20 for the overbought, oversold levels. I'm going to go back to the original of 70-30 and choose Save. And let's expand it. So if you remember, I had about 47.5 for my RSI calculation. You can see that today we've got almost 50, 49.8. So we're a little bit off. Why? Well, there's two reasons. One, I'm not using the current data, and the Dow's up about 250 points right now. So we got a lot of big changes coming into these numbers. But also, it depends on how far back you go where you start your data because of the smoothing that I talked about. It will change the calculations over time. I've only gone back 3 months. This is probably going back a full year. So we could be off for that reason. But that aside, you've got the basic idea. And the way that you interpret RSI is exactly like the others. Remember, just because it's above your high point, in this case 70, which is right here, doesn't mean that it's necessarily going to be a bearish signal. Highs can go higher. Where's our bearish signal? Once we cross from the high side down. So right here would be kind of your bearish signal. Here would be another one. Anytime we cross from the high side down. Conversely, where are the bullish signals? Whenever we have broken the bottom band, or 30%, like we did right here, but we cross back up. So that little point right there would be a bull signal. And you can see right here, if we expand the chart a little bit, got that nice little bull run. So it will give you some nice signals, but we have to wait for the right trigger points. Remember, the mistake that a lot of new traders make is just because the line has crossed above, and it will shade these in gray for you, or it's crossed below, doesn't necessarily mean that it's therefore bearish or bullish. We have to wait for the cross, and then that's what gives you your signal. So right now, you can see that we're basically at 50%. So based on what we talked about, what does this mean? It means that the average number of gains coming in is equaling the average number of losses going out, or $1 in, $1 out, about 50% ratio. So we're just kind of right here in no man's land. Not overbought, not oversold, not really a great buying opportunity, not really a bad one. You're just in the middle. Now these are times for the options traders, especially if you're playing the bullish side, the long-term trend. I really wouldn't do anything in these levels. I would wait until we get up into here before I do my hedges, rolls, and morphs. And then once we cross over, then there are other things we can do. In fact, we might even decide to change directions depending on the strategy. But in a case like this, I just let it sit. No real reason to do anything. So I hope that gives you a pretty good sense of what RSI is, gives you a little more confidence on how to use it. Start practicing with them on your platform. Post some comments, let me know what you think, and we'll talk about some more next week. For those who'd like to know more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com. And if you're looking for some great information, lots of free videos, market commentary, please join us on the Facebook trading group, Options A to Z. It's a free site. We'd love to have you join.